So good afternoon, everyone. My name is Maurya Hanspal, and in this session, we're going to continue our sessions on investment banking. So in the previous session, we tried to understand that what do we mean by investment banking, and what is the major task of investment banker. So the task of investment banker is not only to help the companies or assist the companies in bringing up their initial public offerings or IPOs, or being the lead manager in case of IPOs, or being the underwriters in case of the undersubscription of the IPOs. The task includes a broader aspect. The person must have knowledge on the fundamental analysis of the company, that is, understanding the company on the basis of its past performance, reading, understanding, and analyzing, interpreting the annual report of the company, which is again a snapshot of the performance of the company. Talking about the profit and loss statement of the company, which is also called the income statement. Talking about the balance sheet or the position statement, the cash flow statement of the company, the statement of equities, and the notes to accounts. Trying to analyze the management discussion and analysis report, as we call it as the MTA report, go, going after the CSR activities and the ESG norms of the companies, trying to understand the different types of auditors report of the company, that is whether it is qualified, unqualified, adverse comments, or disclaimer of opinion. So all these things we have to do while doing the fundamental analysis of the company. Then we have to prepare the financial model of the company, and we have to project the future of the company on the basis of the past performance. Like for example, if we are in the year of 2020, then seeing the performance of the past year 15, 16, 17, 18, 19, and 5 years, and like projecting it for the future 21, 22, 23, 24, and 25, like on the basis of the past data. Then trying to value the company and talking about the valuation of the company, right? That whether the company is undervalued or overvalued or being at a fair market price, calculating the intrinsic market value of a share. And we also talked about the differences between the market capitalization and the enterprise value. Because the market capitalization, it just takes into consideration the price of the shares into the number of the free floating shares outstanding and not held by the promoters. And when we talk about the enterprise value, it basically talks about both the equity and the debt component. Then some scientific tools, and at the end talking about the strategy of investing, that is the value investing or the growth investing. So all these things we try to understand. So today, like in today's session, I would be starting about like one of the most important tools in investment banking, used to value a company, used to calculate the enterprise value of the company, and also used to calculate the intrinsic market value of the share of the company. Okay, and that is the method that we talk about in the income approach. And just write it down. Yeah. This is one of the most important methods, like which is used in the analysis or for the task of investment banking, the income approach. And in the income approach, we talk about the DCF. DCF is the discounted cash flow analysis. Discounted cash flow analysis. Right, yeah. DCF stands for the discounted cash flow analysis. So what basically are we doing here? We're trying to project the future cash flows. Like for example, just assume that we are in the year of 2020. So on the basis of the past performance, that is from 2015 to 19 or 2017 to 2017, 18, 16 to 20 basically, including both the years of 16 and 20, like we have the 5 years. So taking into consideration the past performance and analyzing it on the like for the future. So basically we are doing the prediction, forecasting, and estimation of the future cash flows on the basis of the past cash flows. And how to do that, a separate lecture series has been done on financial modeling, but still I will tell you in very brief about the basic concepts of like DCF. So once we have done the future projection of the cash flows of the company or the profitability of the company, so basically since it's a discounted cash flow analysis, so we'll be using the cash flows of the company only, and basically like not the profitability. So when we talk about the cash flows of the company, so once the future cash flows have been forecasted and predicted on the basis of the past values, so we have the future one. So now we'll have to discount those future values on the basis of the present. That is, we want to know that what is the present value of those future cash flows. If on the basis of the past data, we have projected or forecasted the future cash flows, we need to know the present value of those future cash flows right now. And how we gonna get that? We get it by a discount rate. This R is called the discount rate. This R is called the discount rate. And how do we calculate the discount rate? It is nothing but your weighted average cost of capital, or the cost of capital, which is denoted by KO. So what do we mean by the discount rate, or the weighted average cost of capital, or the overall cost of capital, or just the cost of capital? In like startup analysis and venture capital field, it's called the target rate of return. Okay, so all those things mean the same thing. It basically means the minimum return desirable by all the capital providers of a company. And who can be the capital providers of the company? The capital providers of the company can be your debt holders and equity shares in lump sum. So, for example, if someone has purchased the equity of that company, so he has got a certain percentage of stake into that company. So he becomes a shareholder up to that extent. So obviously that person wants certain return on his investment in terms of equity. Similarly, if a person has purchased the bond of a company, or a debenture of a company, or a fixed income instrument of a company, similarly that person would also want a certain return in the form of a fixed rate of interest. Right. So basically, when we talk about the weighted average cost of capital, or the overall cost of capital, or the cost of capital, or simply the discount rate, we include both the sources of capital, that is from equity and debt. And that one thing which is very important. Okay. So basically, when we are basically calculating the present value, right? And what do we mean by the present value? It is, see, basically what our main aim is, we have to calculate the intrinsic value. And the intrinsic value is nothing but the basic fundamental value on which every analyst would agree. Okay, so it is the basic fundamental value of the company, the intrinsic value. So basically, through the income approach, in which the first method is the DCF analysis, that is the discounted cash flow analysis, our task is to discount the future cash flows to the present value. Discount the future cash flows to the present value. And if you still don't understand, a separate lecture series have been done on the income approach, though we'll still try to understand in the basic sense that how do we discount the future cash flows value like into the present value. Okay, so like there is one more thing. Obviously the amount that you're going to get from that, it would be on the basis of certain investment. Like for example, if I purchase a machinery today, and basically like that machinery is used to manufacture some products or services. So obviously, if the cost of machinery is 1 lakh rupees, I would always want that the return that I get from that machinery should be more than 1 lakh rupees, right? Because ultimately, if 1 lakh rupees is the amount I have purchased that machinery for, the cost of that machinery, obviously I want certain return on my investment. A certain amount must come to me. Obviously, either like basically the products or services that I would be offering from that machinery, the value from those products and services should be more than 1 lakh rupees ultimately, so that my amount is almost recovered, or it should be at least more than that, so that I can have a certain profit also. That is the main essence of discounted cash flow analysis. We are discounting the future cash flows on the basis of this discount rate, which is nothing but your weighted average cost of capital, or the cost of capital, or the overall cost of capital, and having the present value. Okay. So that is one thing you need to be well aware of in terms of DCF analysis. Okay, so now I'll share you a screen. Yeah. So here we have the discounted cash flow analysis. Like we'll be talking about all these analysis. So what exactly are we doing in the discounted cash flow analysis? So I'll just share my screen, and this is my screen here. So it basically shows you the future cash flows. Just assume that we are in the year 0 right now. Year 1 and all these, year 2 value of 5,000, year 2 value of 6,000, year 3 value of 8,000, year 4 value of 7,000, year 5 value of 4,000. All these are the future projections. Okay, these are not the proper value. These are just the future projections on the basis of the past projections. And these can be different as well. Because even the top analyst, the best analyst or investment banker, he also fails to predict the exact value. There can be some changes. He can also be right, but there can be some changes also. Okay. And then how to predict the future cash flows, that I have told you in the financial modeling session. So these are the projected future cash flows: 5,000 rupees for year 1, 6,000 rupees for year 2, 8,000 rupees for year 3, 7,000 rupees for year 4, and 4,000 rupees for year 5. Now we have the following cash flows in the second section in the numerator. And now our task is to discount these future cash flows. Here you can see the interest rate. Interest rate is nothing but your discount rate or the weighted average cost of capital, WACC as we call it, or the overall cost of capital or the cost of capital. It's one and the same thing. So once we have the cash flows in the numerator, so in the denominator, we're going to discount it with the interest rate or discount rate. So here we have the formula 1 plus the discount rate to the power of time period. So for the first year, the power would be just 1. For the second year, the power would be 2. For the third year, the power would be 3. For the fourth year, the power would be 4. And for the fifth year, the power would be 5. Agar sixth year होता तो power होती 6, and so on. So basically, this is the discounting formula that you need to remember always, where cash flows divided by 1 plus discount rate bracket to the power of time period. Okay. So in the third one, we have the 5,000 divided by 1.08. That was nothing but 1 plus 0.08. In the second one, it is 1.08 to the power of 2. So when you do 1.08 to the power of 2, you get 1.17. In the third one, it is 1.08 to the power of 3. So when you do 1.08 to the power of 3, you get 1.26. Then you have 1.08 to the power of 4. So once you do it, you get 1.36. And the last one, when you do 1.08 to the power of 5, you get 1.47. So once you do this, in the last column, you have the present value of the future cash flows. Because ultimately, all these values, 5,000, 6,000, 8,000, 7,000, 4,000, were the future values of the cash flows. And then you discounted these future values to the present value, and you got the following amounts. 4630 for year 1, 5144 for year 2, 6351 for year 3, 5145 for year 4, and 2722 for year 5. And then you have to take the summation of all these present values. That is 4630 plus 4144 plus 6351 plus 5145 plus 2722. So once you add all these 5 values for year 5, because ultimately these are the future discounted values. मतलब फ्यूचर में 5,000 है तो उसकी आज की वैल्यू कितनी है 4630 है. फ्यूचर में अगर 6,000 है तो उसकी आज की वैल्यू कितनी है 5144 है. फ्यूचर में अगर 8,000 है तो उसकी आज की वैल्यू कितनी है 6351 है. फ्यूचर में अगर 7,000 है तो उसकी आज की वैल्यू कितनी है 5145 है. फ्यूचर में अगर 4,000 है तो आज की वैल्यू कितनी है 2722. एंड दिस इज नथिंग बट why the values are more in the future, because of just inflation, right? So that is why the discount rate also includes the aspect of inflation also. Okay, so once you add all these values, you get 23,992 only. So just assume these are the cash flows generated for the purpose of machine. मतलब कि machinery से like you are manufacturing the products and selling it, like selling them in the market, and you are getting a certain return. And you purchase the machinery for 20,000 rupees. And now they want to know about the net present value. Net present value. So how to calculate the net present value? It is nothing but the present value of the future cash flows minus the investment value. अब investment value की तो तुम present value तुम निकाल नहीं सकते, because investment जितनी की करी है that is only the present value, right? And उसके basis पे तुमको उससे ज़्यादा का return चाहिए. So obviously you are getting like more return than that, because 23,992 is more than 20,000 rupees. So once you took the differences between the two, you got 3,992. Okay, so that one thing is important. So when the net present value is positive, net present value or the NPV as you call it. So when your NPV is positive, it means the project is good and you can accept the project. And once the NPV is negative, it means the project is not good and you can reject that project. Okay. So that one thing is important into this analysis. Okay. The one thing that we talk about is the internal rate of return, IRR. So as per now, like just ignore these values of Nestle and Britannia. Like this was my personal understanding and analysis that I did for these companies. So the internal rate of return is basically the value at which the net present value of the future cash flows, it turns out to be 0. Just remember this line, internal rate of return or the IRR is the value at which the net present value of the future cash flows, it turns out to be 0. Okay. And what do we mean by higher IRR? The higher IRR means the investment is able to generate higher return. And go for an investment that generates a higher IRR, because it is ultimately the final return that you are getting. Okay. Now the question arises, if the internal rate of return is same as the final return that we are getting, so what is the difference between the return on investment and the internal rate of return? So see, like whenever we talk about the internal rate of return and the return on investment, so a return on investment ROI is what? It is ultimately your earnings EBIT by your total investment. Okay. So here the term ROI it's used more in terms of the income. मतलब तुम न्यूमरेटर में तुम इनकम रख रहे हो एंड डिनोमिनेटर में लाइक यू आर कीपिंग इन्वेस्टमेंट, whereas इंटरनल रेट ऑफ रिटर्न में तुम देख रहे हो उस इन्वेस्टमेंट की वैल्यू कितनी बड़ी है, उस पर तुम इनकम नहीं ले रहे, उस इन्वेस्टमेंट की वैल्यू कितनी बड़ी है. बट इन द रिटर्न ऑन इन्वेस्टमेंट यू आर सीइंग हाउ मच इन्वेस्टमेंट पे तुम्हारा कितना प्रॉफिट हुआ है. Okay, so that is like one of the differences. And also like when we talk about the ROI or the return on investment, it basically means कि final मान लो कि तुमने 5 साल के लिए करा invest. Okay, so after 5 years like how much you are getting. Okay, so that is one thing. After 5 years, how much are you getting? Whereas when you talk about the internal rate of return, it means कि per year के basis पे तुम्हें कितना हुआ है. मानो कि अगर तुम्हारा 5 साल का रिटर्न है, 5 साल का अगर तुम्हारा रिटर्न है, तो बेसिकली इट मीन्स कि 1 साल में कितना रिटर्न आया, फिर 2 साल में कितना रिटर्न आया, फिर 3 साल में कितना रिटर्न आया. ओके, सो दैट इज वन थिंग दैट यू नीड टू नो. ओके, दैट इज वन थिंग अबाउट द इंटरनल रेट ऑफ रिटर्न. That is the first method of the income approach when we talk about the DCF analysis, and that is the first method. The second method that we talk about is the capitalization rate. The second method that we talk about is nothing but your capitalization rate. Okay. So when we're talking about the capitalization rate, it is mainly for the mature companies. Okay. When we were talking about the discounted cash flow analysis or the DCF analysis, it is for the companies that are either at a growing stage or are maturing subsequently. But when we talk about the capitalization rate, it is for basically for the mature companies, the companies that are mature or the companies that can get a return in future. Don't get not a so much return in future because these companies are not in a growth stage basically. Okay, so these companies are not into a growth stage. These are the mature companies. So your capitalization rate is basically as a geometric mean, GM. Okay, like for example, formula is 1 plus rate of return R1 into 1 plus R2 into 1 plus R3, number of years minus 1. So for example, if in the first year the investment is expected to grow by 8%, in the second year it is expected to grow by 9%, third year it is expected to grow by 10%. Third year का हो गया, ये पूरा multiply करोगे. So when this bracket will open, your n will become 3 whole to the power of 1 by 3 minus 1. Calculate करके जो भी value आएगी, just subtract 1 from there. Okay. So here you're gonna get your capitalization rate. So that is the one thing that you need to know. Okay. The basic difference when we talk about the capitalization rate and the income, because like rarely people talk about the capitalization rate. Like when they talk about the income approach, in 99% of the scenario they talk about the DCF analysis, like which is for the companies like which are into the growth stage. So this analysis can also be used for the companies which are at a mature stage, but at a mature stage now, the problem is there that you cannot predict a fixed discount rate or a fixed growth rate basically. मतलब कि that is the problem. वहाँ पे मतलब कि growth rate gets changed all the time. That is the problem that comes there. Okay, like whenever you talk about this. So this was about your geometric mean. Going back, yeah. So like whenever we talk about this income approach, never forget the DCF analysis. If you want to make a career in investment banking or being a financial analyst in any of the companies, a big company, a small company, or a startup company, DCF analysis is everywhere used. It is taught to you in your BBA BCom syllabus if you have opted for the finance elective. It is taught in your MBA syllabus, and it is also used by top financial analysts as well. Discounted cash flow method. Even the top financial analysts of like big companies like JP Morgan, Goldman Sachs, Morgan Stanley, when all these companies are using the DCF analysis to value the company. And there is a whole kind of elaborative procedure, like when we talk about the valuation of the company. Okay. The whole elaborative procedure is there. One thing that you need to know about. Okay. So this is something which is like very important, I would say. Though at a certain point of time, you might argue that the capitalization approach is not so beneficial as the income approach. You can argue upon that. But the discounted cash flow approach in the income approach is very beneficial. That you need to know. Okay. Now, the second approach that we talk about is the comparables approach. It's hanging. I'll just remove it once again. Give me a second. Second approach that you talk about is your comparable approach. So what is basically happening in the comparable approach? It's also called an approach of relative valuation. It's also called the approach of relative valuation. So basically what is happening in this approach, we're trying to compare two companies. One can be a listed company and the other can be the unlisted company. And this method is used a lot in case of the IPO valuation. Like for example, when a new company is getting listed on the bourses, by the bourses I mean on the stock exchanges. Okay, so that company will compare itself with the other company within the same industry. Like for example, if a new information technology or IT company like wants to get listed, so that company will tend to compare itself with the similar company within the same industry. For example, Infosys, Wipro, TCS, Mindtree, all these companies. So compare your company only with a similar company within the same industry. For example, if you are launching an automobile company to get listed on the stock exchange and you want to know the share price of that company, so you have to compare your company with an automobile company only. For example, Maruti Suzuki, Tata Motors, Isha Motors, Hyundai. You cannot compare your automobile company with Tata Steel or Infosys, InfoEdge. Okay, so always compare your target company with a similar company within the same industry. And that was like one of the problems for which these platform companies were facing. Because these companies had no comparables, and even to have comparables with the IT companies, the companies were the loss making companies. Okay, so that created a problem. So in this case, you have to compare your company with a similar company, and that should be within the same industry only. Okay, so that is one thing. So here you have two types of multiples. One is the comparable multiples, and the other we call as the transaction multiples. Transaction multiples are basically used in mergers, acquisitions, amalgamations, and takeovers, where comparables are used in general. Okay, so like when we talk about comparables, you have the P ratio, you have the PB ratio, right? So now what exactly do we mean by the P ratio and PB ratio? First, let's talk about EPS. That is your earning per share. And people say higher the EPS, it's better for the company. The formula is ultimately your net profit divided by your outstanding share. So higher the EPS, it is best for the company because ultimately we want the profitability of the company to be higher. So if in the scenario the EPS of the company is rising, it's a very good indicator. And from this EPS, like we can derive the PE of the company. How to get the PE of the company? A PE of the company is the current share price of the company divided by your EPS. And people say that this ratio should be as low as possible because ultimately, like you want the EPS to be more. Okay. So basically, it is showing you how overvalued or undervalued your company is. But you cannot just do it for the sake of your own company. Like, for example, if my company is into the IT industry, so I'll have to take the average PE of all the companies within the IT industry. So if the average PE, it comes out to be 2 and my PE is 1.4, it means my company is undervalued as compared to my peers. If my average comes out to be 2, it means it's fair value. But if my PE, it comes out to be 3 or 4, it means that my company is overvalued in that scenario. Okay. Same you have to do with EPS. EPS is not a comparable measure, though P and PB are the only measures. But this thing you have to do. You cannot just conclude your analysis on the basis of your company only. Okay. So that thing you'll have to do, like when we talk about the comparable approach. So coming back to PB ratio, so your price P ratio for all of those who want to know the full form is called your price to earnings ratio. Okay, it's your price to earnings ratio. And your PB ratio is called price to book value ratio. Again, it shows that whether your company is overvalued or undervalued. It means if the price at which the company is trading is so high and the assets, that is your book value, but assets minus the depreciation is your book value and the carrying value. The price of the company is so high and the asset that the company is trading is very low. It means that the company is overvalued. The company के पास assets तो है नहीं, but price बहुत ज़्यादा है. Okay. On the other hand, if the price is very low and the book value is very high, it means that the company is undervalued. Because price बहुत सस्ता चल रहा है, but company के पास assets तो बहुत strong है. Okay. In that scenario, it tends to be undervalued. So in price to book value ratio, what is big book value is the cost of the assets minus the depreciation amount, जो final बचता है. It's a book value or the carrying value. It's one and the same thing. So price, if the price is very high and the assets that the company have is very low, it means the company is overvalued. But if the price is very low and the assets that the company has is very high, it means the company is undervalued. Okay, so again, that scenario is very important.